Understanding macroeconomic factors, a comprehensive overview. Macroeconomic factors are critical elements that influence large-scale economic dynamics within a region or nation. They are substantial fiscal, natural, or geopolitical events that resonate across various sectors, affecting vast populations rather than isolated individuals. Understanding these factors is essential for economists, businesses, and consumers alike, as they can have profound implications for financial stability, economic growth, and policy making. Key characteristics of macroeconomic factors. Influence on the economy. Macroeconomic factors include broad indicators that gauge the performance of an economy. These could be economic outputs, unemployment rates, or inflation, all of which serve as barometers for economic health. Interconnectedness. The interplay between various macroeconomic factors is a focal point in macroeconomic study. For instance, how inflation impacts unemployment, or how fiscal policies can enhance or limit economic production, are critical inquiries in this field. Positive, negative, and neutral macroeconomic factors. Macroeconomic factors can be categorized as positive, negative, or neutral. Positive macroeconomic factors. Positive macroeconomic factors promote economic stability and growth. These include low interest rates. Lowering interest rates by central banks can stimulate borrowing and spending, enhancing economic activity. Decreased fuel prices. A drop in fuel prices, such as in the U.S., can lead to increased consumer spending on retail goods, generating higher revenues for suppliers and boosting stock prices. Technological advancements. Innovations can lead to improved productivity and efficiency, ultimately contributing to economic growth. Negative macroeconomic factors. Conversely, negative macroeconomic factors can destabilize economies. Examples entail unemployment. High unemployment rates can lead to economic downturns, as fewer people have disposable income to spend. Economic crises. Events such as the 2008 financial crisis caused widespread economic distress, resulting in tighter regulations and financial constraints globally. Natural disasters. Events such as hurricanes and earthquakes can destroy infrastructures and affect long-term economic stability. Pandemic impacts. The COVID-19 pandemic epitomizes a negative macroeconomic factor with profound effects, including mass unemployment, business closures, and subsequent inflation. Neutral macroeconomic factors. Neutral factors, while they might provoke changes, do not inherently signal positive or negative outcomes. Their impact often depends on context. For instance, trade regulations. The introduction or lifting of trade barriers can have both beneficial and detrimental effects on different sectors and economies, depending on various situational factors. The macroeconomic factor cycle. Economies typically experience cyclical trends, influenced by macroeconomic conditions. These cycles can be described as follows. 1. Expansion. Positive macroeconomic factors lead to increased consumer demand and spending. 2. Peak. As demand surges, prices may rise, creating inflationary pressures. 3. Contraction. Eventually, as prices rise, consumer spending may decline, leading to slower economic growth. 4. Trough. This phase can lead to economic downturns, leading back to the cycle's beginning. Understanding this cycle is essential for predicting economic health and stability. Key macroeconomic indicators. Some primary macroeconomic indicators to watch include: inflation measures the rate at which general price levels rise. Employment levels indicates the health of the labor market. National income reflects the total income earned by residents of a nation. Gross domestic product, GDP, a crucial indicator representing the total value of all goods and services produced in a country. Differentiating macroeconomics and microeconomics. Macroeconomics contrasts with microeconomics in focus and scope. Macroeconomics deals with the economy at large, analyzing overall trends, cycles, and systemic policies. It looks at aggregate indicators and national policies. Microeconomics centers on individual agents, such as consumers and firms, and their interactions in markets. It seeks to understand pricing, supply and demand, and consumer behavior. Impact on businesses. Macroeconomic factors can significantly affect businesses, especially those that are cyclic in nature, like automotive or luxury goods. Understanding the economic environment allows businesses to adjust strategies. With knowledge of economic conditions, businesses can alter their marketing and operational strategies to either expand or consolidate based on anticipated demand. Manage risk. Proactively identifying macroeconomic trends helps in risk management, allowing businesses to safeguard their finances and resources. Conclusion. Macroeconomic factors are vital for understanding the economic landscape of any nation. Governments strive to manage these factors to ensure stability and growth, but economies inevitably fluctuate through cycles of boom and bust. By staying informed about macroeconomic trends, individuals and businesses can enhance their financial resilience and decision-making processes, ensuring they are better prepared for the inherent uncertainties of economic landscapes. Staying attuned to these factors is not just beneficial, it's essential for navigating today's intricate global economy.